To introduce our guest for today. So today we have with us Neil Borate, Aditya Kondawar, and Aprajita Sharma. So Neil is a deputy editor at Mint, and where he heads the personal finance team. And those who are familiar with him also know that he shares quality content on personal finance and also appear in so many spaces and other podcasts so as to share his knowledge. So he's a graduate in law and economics, and he started writing about personal finance in the year 2016 at Value Research. So basically a mutual fund research portal. And after a few stints at fintechs, Neil joined Mint in the year 2019. And as a reporter, he was covering mutual funds and other investments. And he was editor since 2021. And we also have Aprajita Sharma with us, a financial journalist, and she has also worked across diverse media formats from digital to print to broadcast. And she now freelances with Mint, Fortune India, Outlook Money, Angel One, Kuvera, and a couple of other mutual fund houses. And we also have Aditya Kondawar with us, and he's a partner and vice president of key accounts at Complete Circle Capital Ltd, basically a Delhi-based financial services company. And he has over 6+ years of financial services sector journey, which spans across investment banking, equity research, and even entrepreneurship. So he did his PG diploma from NISM. So a very warm welcome to all three of you. And please pardon me in case I didn't pronounce your names correctly. And anything if I missed out on your introduction, I would request you, three of you, to take your time and tell our attendees about you. Yeah, we can go with Prajita, ma'am.
Yeah, you have covered it all. It's just that I'm also a certified financial planner. So that is it.
Right, thanks. So Aditya, you want to say something?
No, yeah, Prince, thank you for the warm welcome and the kind introduction. And all three of us would like to thank you for giving us space today. Yeah.
Thanks, Aditya. And Aditya, maybe you can check on your voice. It's little.
Yeah, I also felt the same thing.
You can please check on your network so that attendees can listen to your insights
Is
with
it fine now?
clarity. Yeah, Neil.
Yeah, Aditya, just same thing I was going to say that just check the audio.
Is it still problematic?
It is clear, but you are low on your voice basically. And the voice is clear, but I think. Anyway, we will let you know in case we won't be able to listen to your thoughts.
Sure,
Yeah,
sure.
Neil, you were saying something.
No, we can start off with that. In the meantime, Aditya can fix the audio.
Okay, so first of all, I would congratulate three of you for your great book, and we'll be discussing various nuances which have been covered in the book. And thank you so much. I received the copy in the afternoon today, and surely as soon as possible, I will go through it and share my honest feedback with you guys. So let me start. Basically, when it comes to investment, so I would be keen to know how it all started for you before coming to the questions on the great book. So small nuances, if you want to share with our attendees, please.
As in how it all started about the book, or exactly what?
Like the investment journey, or maybe the start of your career. And the second question would be on the book thing. Yeah.
Okay, so yeah, so I started my career in journalism in 2014. So I did my mass communication from Indian Institute of Mass Communication, Delhi. So from day one, I was quite sure about it that I have to get into business journalism, not political or any other beat. So since day one, I used to write on economics and other financial markets, etc. And when I entered into job, so I got campus placed at Economic Times. So from day one, I started covering stock market. So that is how my investment journey began. So my own money, I started investing when I got my first job, and that is how I have learned everything at workplace. It's all practical knowledge and the way I've studied and everything. That is how I've grown in my career.
Great, great. So, Aditya and Neil, you guys can go one by one, or shall I call out names? Which way it would be better so as to make it
Sure.
more structured?
No, I can go next, and perhaps Aditya would have fixed the audio by then. So my journey is very different from Aprajita's. I was very confused. I studied law, and then I decided that I needed to study economics. So I spent a lot of time figuring out what I wanted to do, and I initially wanted to become a financial advisor or a planner. Um, but then when I was actually working for an RIA, and that's when a value research advertised a vacancy for an editor's position there, and it was one of my favorite. In fact, is one of my favorite websites. So I jumped at the chance, and since then I have been writing about personal finance specifically, not any other kind of business journalism. And it's fantastic. It's my passion. It's what I love to do. As an investor, I have made all the mistakes in the world, and I'm the great caution story. I have lost money on F&O. I'm one of those 89% people who lose money according to SEBI. Um, of course, over time I learned. So now I have a very boring investment style. I mostly there's one fund that I like. I'm happy to name it. It's Parag Parikh FlexiCap. So I'm an investor there, and also in their conservative hybrid fund. So now it's I just stick to mutual funds, and I don't do very much by way of any changes or anything. It's a very static portfolio. I do have some gold ETFs because I have a soft spot, you can say, for gold. And in fact, I want to talk about this later on when we talk about the book, because psychology plays a lot of has a lot of influence in how we invest. And I'm naturally pessimistic. I'm naturally unable to see the light and the bright side of things. So I'm drawn to gold. I'm drawn to hedges against bad things happening. And I'm always relatively under invested in equity. Relative to my age, I'm young. I should be very, very strongly in equity. I'm not. And one of the big things that Rakesh was able to do is maintain that optimism, maintain that sunny disposition that makes a successful equity investor.
Aditya?
Yeah, am I audible, guys, now?
Yeah, yeah, loud and clear.
Yeah, it's much
Perfect.
better.
So my story is kind of a cliche. It was 2012. I had just started doing my bachelor's in financial markets. I was in Manipal University. So the thing was, our financial position was a bit weak. We had my father had some losses in his business, and naturally, I joined Manipal, and then I always had that wish, ki, I should find some way to earn some extra money on the side. We used to get some pocket money from home every month, and 2012 to 15 was one such period where a lot of IPOs came and they gave good returns. So a few of my classmates used to pull in their pocket money, and they used to apply to IPOs. So I started doing the same, and I made a lot of good money, and that's how I got hooked to the financial markets. Along the way, I also made mistakes. I thought IPOs are a lottery ticket, and all sorts of misconception I had about the market. I thought making money in the markets is extremely easy. But then I made a lot of mistakes, and I learned from those mistakes. And after making every mistake, I thought, okay, let's try to correct myself. Let's try to be on a correct course. And it has been a very good journey. I started in 2012, and I have made some mistakes, but overall, what I've always tried to do with my money is that I've tried to save aggressively, invest aggressively, and fast forward to now, I don't save that much aggressively, but yeah, I try to save and invest every month, and the book kind of resonates with us because Rakesh Jhunjhunwala was someone who was a perma bull. He always saw the big picture, and I believe that all three of us are also kind of similar in the same way because we try to see the bigger picture, and yeah, that's my journey.
Great, thanks, Aditya. So guys, what inspired you to write a book on life of late Rakesh Jhunjhunwala? Like, who among three of you initiated, and like how it all the portions I was looking at, like the book is divided in three portions. So I mean, who will take up which section? So how it all started, and you decided that I'll take this, and what would be the structure of the book? Yeah.
Sure. So I'll answer that. So I'll give the deeper reason first why we decided to write this book, and then the more practical reason afterwards. So as the way I see it is, Rakesh Jhunjhunwala embodies the Indian dream. He embodies the Indian investor's dream that if you do pick your stocks right, and if you do stay for the long term, you can make a fantastic amount of wealth. Now he's an extreme example. I mean, 99.99% of people are never going to make anything close to what he made, but in our own ways we can be somewhat successful by taking inspiration from what he did. So writing about him is writing about the Indian equity dream, nothing short of that. So that's the kind of the big picture reason of why we decided to write this book. On a practical level, so I was actually initially writing a book on personal finance, and then um, last year Rakesh ji passed away. So suddenly somebody suggested that why don't you change track, you can write that personal finance book later on, but this is what you should be writing about now. So then I contacted Aprajita and Aditya, and we put together the book. There are three sections. So as you rightly said, the first section is a short biography. The second section is three companies that made his fortune and three companies where he made mistakes. So that's been written by Aditya largely. Although all of us have inputted on all three parts. So it's not like, this is my territory and that is your territory. It's all our collective effort. But on a practical level, we divided it that Prajita and I wrote part one, Aditya wrote part two, and part three is the lessons that you can draw from Rakesh's life. And that one, again, Prajita and I wrote together.
Great, great. So like when it comes to researching and gathering information, so how easy or difficult it was for you guys? Because most of the information is in public domain, but there are always other.
Since you are not audible.
Sorry, Neil,
Yeah, Prajita,
am I audible?
I think there's some problem with your audio. Yeah, Prince, you're audible. Prajita, there's some issue at your end, I think. So,
Oh, okay.
hello,
Yeah,
can you hear
yeah,
me?
Neil, I can listen to you. I'm
Yeah,
not sure Prajita is able to
yeah,
listen to me or not. Anyway, you can pass on the
yeah.
Now
So,
I can
Okay,
listen to
okay.
you. Yeah.
So the question was like, how did you research and gather information about his life, and like how easy or difficult it was for you guys
yeah,
to gather the information which is not in public domain?
yeah. So let me take that quickly, and Prajita can supplement it. So
Yeah.
there were two problems with when we began writing this book. One was the problem of plenty, because all his life Rakesh has given so many interviews, hundreds of interviews on television, video, print, everywhere, that simply putting together all that material was a big task. And then there was a problem of um, the people around him, the circle around him is very closed. It's very difficult to get them to talk, and to talk on record is almost impossible. So a lot of the times we had to take things off record, which is fine, but it's, we essentially had to fight two battles at the same time. One was the humongous amount of information out there in the public domain about him and interviews he's given, and the other hand, the tight, close knit circle around him, which was difficult to get information from. So I'll stop there. Prajda can supplement me.
Yeah. So yeah, a lot of information is already there, and a lot of people watch his interviews already. So what different could we produce in the book? So for that, I wanted to speak to different people, and we started doing it right after Penguin accepted our proposal. And we in fact went to Nariman Point, his office, to meet Utpal Seth. But it could not happen, and we tried chasing him for many weeks. But somehow, family and Utpal Seth, they were not that willing to talk to us. So that was one major challenge that we faced. And now when we started reaching out to other people, Then they started saying that only if Utpal Seth and family speak to you, only then we can speak to you. Otherwise, we can't comment. So another challenge. And now some people did oblige. Some people did say that okay, we'll speak to you, but off record, you cannot produce our name. So that was fine. We were more interested in knowing different stories, offbeat stories, and lesser known stories about him. Even if we cannot name that person, that is fine. At least we could write fresh content. And then some people did go on record. For example, Shankar Sharma and Ramesh Zamani, they went on record about the information that they shared with us. So yeah, so that was quite challenging for us to find good people to share information about him, but somehow we managed that.
Right. And like Neil and Aditya Prajita, so there is always like some information which is like doing rounds in the investment fraternity, but you cannot basically print that thing in the book. That kind of, do you face any kind of similar situations also?
Yeah, we did feel such situation. And in case of Rakesh Jhunjhunwala, he was quite open and honest and honest, transparent person. He was quite upfront about his views. So not much, just that we had to take care of some legal aspect. So those were there, but otherwise, Rakesh Jhunjhunwala is quite transparent in his views. So we did not face such kind of challenges that we have to hide some information or something. So that was nothing serious about it.
Right.
So I'll add to that. There were a lot of rumors about him. There's no doubt. I mean, all kinds of
Mhm,
people have all
mhm,
kinds of opinion, and we heard all of them. But our golden rule is unless something can be proved, right?
mhm.
We don't want to print it because that opens us up to legal issues.
Right, right, Neil. So what are the most interesting or surprising facts which you discovered while researching about Sir? Because, like, although his most of the things and he appeared so frequently that everything appeared to be in public domain, but always a second side of the story that certain things are not known to everyone. So, is there any instance or any interesting, surprising fact which come to your mind?
Yeah, there are two things definitely that I'd like to point out. So one is there is this legend built around Rakesh picking up Titan in 2002 and um, at some 30, 40 rupees, and then it compounding like crazy. He seems to have picked the very bottom and held it to a massive top. But there was an interview by a Titan executive who talked about Rakesh entering the stock way back in the late 80s and 90s. And I was really surprised to see that because this whole legend around him timing it so perfectly. So if he did actually buy some stake in the 90s and late 80s, it's more about his power of patience that he stood. Because Titan in the late 90s, and Aditya can add to this, was not a great company. They had this European foray where they wanted to sell watches in the European market, and they were spectacularly unsuccessful in that. If you see the stock price in the 90s, it's gone nowhere. So perhaps it's not so much a case of Rakesh getting. He must have picked up a significant chunk in 2002. That I mean, that legend must have been built around some core, but this reality seems to be a little bit different. He was there in Titan for a lot longer than people think. Aditya, if you want to add to that.
Yeah, sure. I mean, see, one story that gets circulated in the markets is that Mr. Jhunjhunwala saw the big runway in Titan. How jewelry was going to get completely organized, and a lot of consumer behavior was going to get shifted to the organized side, right? But I mean, I mean, I found it extremely surprising that the first big chunk that Mr. Jhunjhunwala bought in Titan was just because a broker had offered it to him. So basically, the prevalent market price of Titan was around 31, 32, and this certain broker called Daki had called him and said, "Ki, I have a big block of Titan at 26, 27 rupees." So I think it was around 30, 32 lakh shares or something like that. And so Mr. Jhunjhunwala immediately called his friend, and his friend was like, Morgan Stanley is also going to sell a very big block, and it's going to go down to 20, 22 rupees, and a couple of, tens of lakhs of shares are going to get flooded in the market, and you don't buy it. But Mr. Jhunjhunwala went against his friend's advice, and he went ahead and bought the stock. it was only after he bought the initial chunk, and he wanted to meet the management, and he thought that, okay, I should meet the management and then take a call. And then it was after that initial chunk buying he met Mr. Bhaskar Bhatt, and of course, I mean, of course, you'll come to know everything else in the book, but yeah, I mean, that's what led him to buy more in the company. So, I mean, one thing that I found surprising was that, so in the case of both DHFL and Titan, Mr. Jhunjhunwala had bought a sizable amount in the companies without even meeting the management or without even doing a lot of due diligence, right? So, in one case, it worked out remarkably well for him, where, people give out stories of Titan saying that, उनको कितना dividend आता है हर साल. And on the other hand, of course, DHFL has destroyed a lot of wealth. So for me, the lesson was that, I mean, you should definitely do your due diligence, and luck definitely matters in investing, because we have a clear cut example in front of us, because he did not meet the two managements, but in one case it worked out very well, and in the other case it did not work out.
Right,
Yeah.
Yeah.
Aditya.
Sorry, go ahead.
Yeah, Neil, go ahead, please.
Yeah, the other surprising fact is that a lot of the times we see his journey as like a one-way staircase up. But there was this, for example, the entire dot-com boom. He did not participate. In India, there was a version of it called the TMT, Telecom Technology, and one more thing I forget. So that was rallying like crazy. A lot of fund managers were loading up on Indian IT stocks, and Rakesh was not. And there were like 5-6 years of just doldrums where he was sitting around not making big money and enduring a lot of people saying, taunting him, and like, him being kind of left behind. So again, it tells you that the man had his ups and downs, and long periods of downs.
Right, Neil. So, Neil, like we often hear about, I mean, basically, there is a debate whether he was a trader or an investor. So, can you touch upon that side? Like initially when he started, so he was more into trading, and how to club both the aspects, because it require a different mindset to be a trader and a long term investor. So, I mean, can you walk us through how he had been in his initial years and in later years as far as trading versus investing is concerned?
Yeah, so in the initial years, he clearly built up his capital through trading and by taking huge leverage bets. Some of that initial capital came by borrowing money from his brother's clients. His brother was a CA, and borrowing at huge interest rates. To us, I mean, today, the interest rates sound exorbitant. They were in the, if I remember correctly, some 18% around. And taking big contrarian bets. So, like one famous incident is during the 1990 budget by Madhu Dandavate. So VP Singh was the finance minister, the prime minister, and there was a prevailing bearish sentiment in the market that it's going to be a unfriendly budget. And for whatever reason, Rakesh took a big contrarian bet on that, and paid off. It was his first big success. And then he followed that up. So then after that came Harshad Mehta. Initially, Rakesh was bullish. Rakesh made some money on the up, and then he turned bearish. And that whole battle is very famous and well known. But again, he was a trader at that point of time. I don't think he really became a proper investor until the early 2000s. Something just clicked, something changed in his mind, and he wrote an article in ET that India's moment has come in 2002. And then he bought, in that period he bought some of his big wealth creators, or at least big chunks in them. So Titan, Lupin, um, yeah. Aprajita, you want to supplement that?
Yeah, so I have an interesting anecdote linked to his trading and investing. So, as you know, that Harshad Mehta and Rakesh Jhunjhunwala were big rivals. They belonged to different camps, and so one of journalists who used to cover stock market in 90s. So he told me that Harshad Mehta confided in him, saying that Rakesh Jhunjhunwala, I really admire him. The way everybody used to trade in 90s, but the way he moved from trading to investing, that is something think very few people can do that. And Mehta accepted that he himself could not do it, but Jhunjhunwala could do it. So that is something very amazing that a big rival like Mehta talked positively about Jhunjhunwala. So he had this, and throughout his life, he remained a trader and investor both. So he had this skill set to differentiate between trading and investing. So he may have long term outlook in a stock, and in the same stock, he may go and trade. So that is something very amazing, and not many people can do it.
Right. And when it comes to his inherent optimism about India, that was like from day one until he survived, he was very optimistic about India, and that has given the necessary direction to Indian market. So how, if I were to ask, like, how much you rate his contribution in that sense, so as to develop confidence in the retailers or maybe the market participants, that they should also be optimistic about India, and India ought to do well in days or years to come. So yeah, Neil, Aditya.
Yeah, so I actually don't think he was an India optimist since day one. In the 90s, when he was a trader, I don't see any strong conviction on the long side. It's just something clicked in his mind in the early 2000s. And in fact, 2003 to 7 was our first big bull run. Like most of the 90s, our market was stagnant after Harshad Mehta's boom, after the dot-com boom. So there was Harshad Mehta, then there was some years, then there was dot-com boom and bust. But we were not on some kind of you know multi-year bull run in that period. Anybody standing in the early 2000s would not really, there was no reason to be super optimistic on India, but something clicked in his mind at that time. And he was actually early to the party, to that 2003 to 7 boom. Um, and and because he was early, he actually, in that period 2002 to 3 was very tough on him. It's something that Shankar Sharma told me. But thankfully he got that broad timing right, that he was too early, but still eventually the market rallied, and he made his first big money, or not first big money, but a big chunk of it in that 2003 to 7 boom.
Yeah, I agree. Actually,
Right.
we were just discussing this a few days ago. There was a 2001 Capital Ideas online conference, and Mr. Damani was there, and Mr. Jhunjhunwala was there. And if you really listen to the speech, right, you would come to understand that he was quite vocal of the government's shortcomings. So, like Neil said, right, it was only after this period where he became quite an optimist, and he started supporting all the government incentives, and he started speaking more aggressively about India's bullishness or India's runway ahead. So yeah, I mean, I agree that he wasn't an eternal India optimist from day one.
Right. So we got two speakers. So one by one, we take their questions, and then I ask questions from my end. So Anurag, you can quickly unmute and ask a question to the panelist. Anurag, you can unmute yourself and ask your question. Okay, P Wag, you can go. I mean, you can unmute and ask your question. Guys, am I audible?
Yeah, Prince, you are. I think Twitter usually has a bug where it takes some time for them to speak. Let's just wait for a few seconds.
Okay, no worry. So these you guys can come in between and ask question. So Aditya, like when it comes to the winners, right? So people are revered for their winners, and people mostly talk about the exceptions. But again, there is always a other side of the story. So let's talk about his what we say big losers, and what was the point he his investments went wrong big time. So, what's your take on that?
Sure. So, I mean, if I had to summarize, so there were a few, there was a kind of business which, inherently the business model was weak, right? So let me take the case of A to Z infra engineering services, right? So it was a EPC player which got into waste management, which got into sanitation management, which got into office management. The company was highly levered. Uh, they had a lot of debt. They did a lot of they did a lot of mergers. They did a lot of acquisitions. And 2006, 2007, 8, it was a period when I mean, preceding to that 3 years, the power sector was doing well. If you guys remember, we had the famous Reliance Power IPO. So the government had said that they're going to go big on infra and power, and these are the sectors that are going to take India to the next level, right? So, uh, I mean, naturally there was a big euphoria around the sector. RJ was a pre-IPO investor in A to Z Infra. In fact, it was him who took the company to an IPO, and he even bought more on the IPO listing day because the IPO had listed at a good discount. Now, what had happened was, Mr. Jhunjhunwala kept the faith in the company, and the health of the company started deteriorating, right? So, I mean, you have to give him credit that he started cutting his stake when things got out of control. There was a lot of I would say what you say negligence on the company's part. A lot of equipment had gotten stolen. Insurance was not adequate. They got hit by all problems at once. So you always say that whenever things go wrong, they all go wrong at once. So I mean the kind of business that he bet on, I think he may not really have seen the business go through a stress testing kind of a period as it had gone through the 2008 period. Number two, I think he did hold on to the position for a long period of time. I mean, he could have maybe he could have seen, and maybe he could have given more time to the management to see if they are actually able to turn around the company. Uh, and number two, I think if I take say a company like Mandhana, right? Mandhana Retail Ventures was a company that was one of the losers for him. The company held the exclusive manufacturing rights for Being Human, which is a Salman Khan brand. So how the brand actually works is that whatever revenues they generate, all of it goes to a charitable trust. So again, Being Human is a brand and a charitable foundation as well, right? So over there as well, what had happened was the company was indebted. Then you had the Black Buck case where Salman Khan had gone to jail, and again the company was a traditional brick and mortar kind of a company. It was heavily reliant on a single brand and a single person. Uh, the company had a lot of pledge, but I think Mr. Jhunjhunwala placed more emphasis on the brand. Being Human was a brand, and a lot of people associated with it. But again, like A to Z, all the problems came at a single time, and we all know what happened. So just to sum up, if you have to really learn from his mistakes, number one point would be to bet on those businesses which are not really highly levered. Number two, there should not be a concentration risk, jahan pe the whole premise of the business rests on one thing or one key managerial personnel. I mean, the number two, we see a lot of instances playing out in the market in the past couple of quarters where a lot of banks have corrected because of a single person leaving or coming, right? So just two, three main points. Yeah, I mean,
And guys, like luck also has a very important role when it comes to thrive in the market. So initially, as Neil was telling, like there was luck element also. But if I were to ask you guys about his risk management approach in later times in his investing career, so what was his approach, and what our attendees can basically what could be the takeaways on the risk management and from his journey?
So it's kind of complicated because clearly he held a very concentrated portfolio of what were once small cap stocks. And that is not a low risk strategy by any sense of the term. It turned out really well in his case. For the vast majority of people, I don't think it will. And it turned out well in his case because he had that combination of insight, of skill, of being in the market 24/7, that that all came together for him. So most people, I mean, you should not try that at home. um, and the other part of the other magic that built his fortune, which was leverage trading, again works for a tiny minority of people. The SEBI study showed that 89% of the people don't make money on F&O. So so Rakesh is probably not a good example of risk management. The only uh, perhaps good thing you can draw from him is that his losing bets were very contained. He didn't double down and triple down and quadruple down on some of the companies that Aditya mentioned, which some people do, right? If we see a stock in our portfolio fall suddenly we think let's buy more, then let's buy more, and then you get like stuck in it like a marsh. So he didn't do that. If there was a loser, he didn't fall for that trap.
Yeah, so I have something to add here. So, because he always traded on leverage money, so he did have that mindset, that skill set in his mind, that he used to do some calculations that if stock has fallen below a level that he had set for himself in mind, then he would sell off. He won't think twice about it, how are going to behave and what the positive or negative news about stock is. So, a certain calculation he did have in mind, and not many people are savvy enough to do that. So that is how he used to manage his leverage trades. It's not for everyone. So in our book we have clearly mentioned what not to learn from Rakesh Jhunjhunwala, and in that we have highlighted that this leverage trading is not for everybody. It's very rare, few people can do that, and he did had that risk management style in his mind.
Right, Aprajita. So, Aditya, any other thing which what not to learn from him that comes to your mind, and what two three pointers which basically every investor should imbibe in their investment process or maybe framework, which one can learn from Rakesh ji?
Yeah. So, I mean, the thing is, see, I think one thing that I really liked about the Big Bull was that he did not tend to fall in love with his stocks, right? So, take the case of Lupin, right? So it was a big winner for him, but he cut his position at a very good time. Lupin had started facing issues in the US. Their drug portfolio, which was more generic leaned, right? So it started facing pricing pressures in the US. A lot of acquisitions that Lupin had done, it had a lot of impairment. So Gavis was one of the famous acquisitions where they had taken a lot. I mean, I think they had taken hundreds of millions of dollars in impairment as losses, right? So if you look at the time period when he started cutting his stake, right, it was I think 2020 start or end, sorry, 2019 end or 2020 start. So it was a perfect time because after that, in just a couple of quarters, all the return ratios, the stock price, the financial performance of the company took a beating for the worst. And number two, like like Aprajit was saying, do not really take leverage at all because leverage can work for you or it can destroy you, right? So it's like a double-edged sword. Now for RJ, it worked well in the initial phase of his career. He could make a good corpus out of it, and then he learned his lesson the hard way. If you have seen Scam 1992, there's a certain dialogue which says that if Harshad Mehta had kept his short positions for one more day, RJ would have been on a footpath, right? I mean, he used some other word, but I don't want to say that in a public space. But yeah, you tend to understand from that dialogue itself that leverage is so harmful, right? Only because if it works for one person doesn't mean it will work for you. And number three, building up upon Neil's point, there were three losers. There were a lot of losers for him, but he did not really tend to say average down the stock price, or he did not really tend to bet the house on those stocks. So, for example, he lost money in A to Z, he lost money in Mandhara, he lost money in DHFL, right? But he did not really bet the house on it. He did not. Matlab, he survived the loss, and he could just come back the other day and he could bet big on another stock. So while his portfolio was indeed lopsided, but I think it was lopsided because the stocks that gave him very huge returns, they became very big in size. Now, of course, when Mr. Jhunjhunwala bet on Titan, he never knew that the amount that he invested, he would get that amount. I mean, 10x or 100x of that amount as monthly dividend, right? So kaisa hai ki he let those runners run, and it became a very big part of the portfolio, and he did not really bet the house on those stocks which were going down. So I think it was a very good strategy.
Right, Aditya. So, Aditya, like when a person becomes successful, so there are times like those persons, maybe other competitors or participant are envious to that person. But again, he was an exception on that front. He was very sharing and very open about his investments, and he was very helpful. I mean, so if we hear from other reputed investors, they also have same view of Rakesh ji. So on that front, how had been his journey, in the sense how he have maintained great humility despite achieving so much in the market.
Yeah, that is his personal character, I believe, that he could do that. And a lot of his friends we spoke to, he did tell us that they did tell us that he would tell them stocks, that invest in this stock and you will make money, and people would listen to him and people would do that. And he would also help his friends financially. So if someone is in need of money, then he'll generously give out amount to help them out in life and different phases of life, and even in investing, in suggesting stocks. But what he did not like was if someone is making losses in one stock in which he told to invest, and people, if they go to him and ask that we are making losses in this one, should we sell, then he would get agitated. So if he has suggested one stock, so you have to be patient enough to stay invested. So one of broker friends told us about it, that he himself made some losses and he was quite worried that a lot of money has now in losses, what do we do? But he stayed quiet. He did not go to him and ask that you may have suggested wrong stock and this stock is in losses. So that was there. So he was humble, but he not really liked people asking back questions. So that was there.
Okay. And I mean, yeah, Neil, please.
Yeah, I just want to add one thing in this context. So there is this whole cult of people who follow Rakesh, as in who followed him when he was alive. Anytime he bought some company, and that gets reported, right? So if your stake is above 1% in any company, it gets onto the shareholders disclosures, your name comes, and then there are all these websites that immediately put out headlines saying Rakesh Jhunjhunwala adds XYZ company to the portfolio. And then there was this whole cult of people who would just try and follow him and clone his portfolio. And it's just a terrible idea on so many levels, because for one, it's not a perfect reporting, right? So we don't know about the companies where his stake was less than 1%. um, the reporting happens after the fact, after he's gone and bought it. We don't know how long he wants to stay there. We don't know um, what his reasons for buying are, but people would just blindly try to ape it. And that's one thing that people should not do. And there's a chance that even after his passing, his portfolio is still there, rare enterprises is still there. These things are going to continue, these headlines are going to continue, and some people will still try to clone it, and it's just not advisable.
So Aditya and Neil, so what was his approach when it comes to basically picking stocks? And was it he was, as we all know, Utpal Seth sir has been with him since quite a long, and he had been helping with the investments. So is it it was a mutual investment framework, or Utpal sir had a free hand? I mean, exactly, if you can walk us through how things, as far as selection of stocks was concerned.
I think two metrics always stood out in the kind of stocks that he chose, right? So number one was of course the runway of growth the company had, and number two was of course the promoter. Now let me give you two examples, right? I mean, in the case of say Titan, right? After he had actually bought the initial chunk of shares from the broker, he got more interested in the company, and he went and met Mr. Bhaskar Bhatt. Now, when he entered the Titan office, right, he Mr. Jhunjhunwala says that it wasn't like a normal Tata office, like all the guys and girls were young. It had a very vibrant culture. It was an open office. Mr. Bhaskar Bhatt he was supposed to meet Mr. Bhaskar Bhatt at 6:30. But before that, he had met a friend from Titan itself, and his friend told him that things are changing in this company. The new MD has come in; they are shaking up things. And Mr. Bhaskar Bhatt came at 6:30. He sat down Mr. Jhunjhunwala in a conference room, and he just said that I have to just take care of some union issues, and he went out, and he came back at 7:30. And so once Mr. Bhaskar Bhatt started talking, right, Mr. Jhunjhunwala sat there for 2.5 hours, and it was after this discussion that he got sold on a Titan story. So, like I said, runway of the company, and to the promoter vision or the company's vision. Now, on the other hand, it was it was a very short discussion with Mr. Vadhavan of DHFL. So Mr. Jhunjhunwala had met him in a flight, and they just started talking about the opportunity size. In fact, even if you go through the interviews of Mr. Jhunjhunwala, right, so you can see what he talks about: affordable housing, the government schemes, the average ticket size. DHFL actually was focusing on the lower sized ticket sizes, and Mr. Jhunjhunwala said how the company will actually enable the bottom of the pyramid, or say a slightly higher bottom of the pyramid kind of people to own their houses, and how it actually perfectly aligned with the government's vision for housing for all. So these two themes always stand out in Mr. Jhunjhunwala's investments, and yeah, I mean that's about it.
So like a hypothetical question. So basically, if not Rakesh sir, what other name come to your mind if you guys have to write some another book? Maybe any renowned investor from Indian equity markets.
Radhakishan Damani. I would love to write about him and finding information around him, and that would be even difficult to do with Rakesh Jhunjhunwala. At least he was there out there, but Radhakishan Damani is nowhere. He doesn't speak to media.
Right, right. So Neil, Aditya, any name to your mind?
Sure. So I think three people interest me the most in Indian investing context. I think number one is Mr. Chandrakant Sampath, who's the actual father of value investing in India. In fact, he was the one who had taught Mr. Parag Parikh value investing and a few other investors as well. The number two is of course the late Parag Parikh sir, because I feel that he was extremely true to his core of value investing, which I'm very happy to see that PPFA still carries. And third one is of course Mr. Radhakishan Damani, because I have been always very interested by his life journey. How he invested, how he built DMart. So there's a very interesting story about him, that when he was starting out DMart, right, his fellow investors used to laugh at him. They used to be like, so when DMart started in Bombay, right? So of course how they used to sell at very cheap prices, and how we were all dealing with cash and coins at that time. So Mr. Damani used to go to RBI headquarters to get his cash change into coins, and then people used to tease him that yaar tu chillar ka kaam kar raha hai, basically you're dealing in change. But then we all know what really happened, right? When DMart got listed and he came in the Forbes list, right? I mean, he's a perfect example of how compounding takes place. He worked in silence for all these years, and I mean, we have the result in front of us. I mean, DMart is an excellent franchise. Matlab, you go there on weekends and you will have no place to even stand. So I mean, it's a perfect example of how to build an institution and a track record. So yeah, definitely in this order, yeah.
Right. And Aditya, it before coming to Neil, it reminds of a chapter from the book of Richer, Wiser, Happier by William Green, Sleep and Jakaria, right? So they had a similar and Walmart business in the late 90s, or maybe if I'm not about the time. So basically, the idea was passing on the cost benefit to the customers is one side of the story, really help you build scale in the business. Yeah, Neil, you can please go ahead.
Yeah, so I would agree with Aditya about Parag Parikh, and I would add to that Rajiv Thakkar, who inherited Parag Parikh's mantle. And I would invite actually everyone here to just go through their AGMs, right? Every single AGM they've done is on YouTube, and where they answer questions on it, practically every single stock in the portfolio, why they picked it, why they sold it, which I have not seen any other MF2, and it gives you a fantastic insight into how they're thinking. So yeah, so just to answer that question, Parag Parikh and Rajiv Thakkar.
So like Rakesh ji, I mean, who were his gurus, or maybe the person he used to respect a lot in the investment fraternity? Any names which I mean?
Yeah, so Manu Manik in initial days, and then Radhakishan Damani. Radhakishan Damani and Jhunjhunwala were more of friends, and but still, Jhunjhunwala would see him as his mentor. So that was there, and Manu Manik in initial days when he entered into stock market.
Right, right. So I mean, Aprajita, like you have been doing financial journalism, like so the research part was mostly covered by you, or I mean, how exactly it went? Because you had a similar nature of the job, right?
Yeah,
Yeah.
so Neil and I, we focused on first part and third part, in which we covered his life and his friends, his family, how he behaved with his employees, those sort of things. And Aditya focused on the research part, in the sense stock research. So stock specific research Aditya did, and with us, Neil and I, we covered other aspects and personal finance aspects, as what to learn from him, what not to learn from him. So that is how we approached the book.
Yeah, no, but Prince, you're right. So Aprajita is a lot more clued into the market than I am. She talks to a lot more brokers and a lot more market players. I'm a boring personal finance journalist, right? So I talk to mutual funds and the very boring side of things. So definitely Aprajita is really the secret to our success.
No, no. We all
Right.
three
So,
work
so
together.
Neil, like, what all personal finance lessons we can take from his life, which comes to your mind?
So some of the ones that I mentioned earlier, one is that leverage works for a very small number of people. Yes, it builds big fortunes, and when we look at these big fortunes, there is this hindsight bias. There is this, or rather, sorry, a survival bias. For every one Rakesh Jhunjhunwala, there would be thousands of traders whose lives would have been destroyed, whose families would have been destroyed. We just don't know them because they don't get highlighted. So leverage should be avoided by most people. That's one. Then his route to success, which is holding a very concentrated portfolio of essentially small cap companies that later on became very, very big, is a very high risk strategy. So I'm not saying nobody should attempt this. Clearly, if you have time on your hands, if you have skills, if you are able to research companies, then you will reap the rewards. I mean, you will be able to capture that alpha. But unless you meet these conditions, you should not attempt this at home. Like, there's this disclaimer, right? Kids, do not try this at home. So do not try this at home.
Right.
Yeah, and even Jhunjhunwala has spoken about it, that if you cannot do stock research by yourself, then go ahead and invest in mutual funds. Mutual funds are always there. So he was a stock guy, but he was a quite strong votary of mutual fund investment as well for normal retail investors. So people should learn that you don't have to get into individual stocks for making money. You can very well do it through mutual funds.
Right. So Aditya, like equity research is like not everybody's cup of tea, as rightly said by Aparajita. Like if a person is unable to do research on his or her own, it is better to delegate it to some advisor or maybe go by passive investing, right? So what I mean learnings you had from him as far as equity research is concerned, and what had been your experience in last 6 years? When it comes to equity research, maybe in the sense like if somebody wants to start in this I mean for equity research, what would be your advice, how one should go about it?
Sure. So see, when it came to RJ's style of investing, right? His kind of equity research was quite different. Like I said, he was someone who always looked at the big picture. I mean, the decision to buy Titan was in a snap of a minute, right? It was only because the broker had called him. The decision to buy DHFL as well was in a snap of a minute because he had met Mr. Wadhwan on a flight, right? So his style was quite different. I mean, there would have been instances where he researched a lot. There were instances where he did not research a lot. Some worked, some did not, right? Now, when it comes to say my own personal equity research, right? I mean, how do you actually do it? I mean, see, it's not some formula, right? Where I can just say, this equity research is equal to this into this, right? So it's while it is quantitative, I mean quantitative part would be same for everyone where you would look at the say big three financial statements, you look at certain ratios, you look at the history of the company. But a major part of investing in any company is qualitative, right? You try to judge the runway ahead for the company. You try to judge the quality of the promoter, Rajiv Thakkar famously says that price is what you pay, and value is what the promoter allows you to get, right? So uh, a lot of times it is the jockey that rides the horse. So I mean, if someone wants to get into equity research, it's not just about the numbers, but also about the qualitative aspects of a company. I mean, you study the entire history of a company. You see what the company has done in good times. You see what the company has done in bad times. You look at the capital allocation history of the company. You see what the company has been guiding for. Are they very aggressive or they conservative? Look at their accounting policies. Again, are they conservative or aggressive? There's, I mean, honestly speaking, there's no set formula, and the framework that you actually use for companies differ from company to company. Now, for a banking company, you would look at the underwriting standards. For a say for a manufacturing company, you would look at the accounting standards. What is the kind of depreciation they are charging? I mean, at some annual reports, you would look at the kind of CSR expenses they are doing. Are they paying taxes on time? I mean, the list is endless, to be honest. But at the end of it, you just pay very special. You pay a special attention to the promoter, because at the end of the day, the promoter will be the one who allows value to get accrued to the shareholders. Net profit is a residual income, right? Net profit सबसे end में आता है. So make sure that the promoter that you're betting on is clean. He's a good guy. He's a seasoned guy, and I mean, then do your research accordingly. I mean, again, this is a very philosophical question, and I can't really sum it up in 1 to 2 minutes. But yeah, pay special attention to the promoter, and just look at the numbers. Are they legitimate or not?
Right, Aditya. So, Aprajita, like, do you see in like last few years and maybe going forward from here any structural change in the markets? Like you have been covering it since long. So, do you see any on the sense of participation, increased participation, and maybe the growth avenues within the market? So, any view on that front?
See, about stock market, I always say that don't focus on short-term noises that are there. So, stock market fluctuations, those will keep happening. But you have to look at the long-term picture. And as Rakesh Jhunjhunwala said, he was always bullish on India. So, if you believe in your country, if you feel that your country will grow, then you have to be positive about stock market as well. Because if your country will grow, then your GDP will grow, and if GDP grows, for GDP to grow, you have to have your companies, all these listed companies, top funds, they have to grow. And if they have to grow, then obviously stock market will also go up. So that is the logic that I always tell people, that if you are confident about your own job, if you are positive about your own future, then you have to be positive about stock market as well. So I so that is that, and when it comes to individual stocks, then you have to get into specifics, economic cycle. Then you have to study which sectors will do well in coming years, in next couple of years. That is how you have to approach it. But looking at broader picture, you must know that Indian stock market journey, it will keep growing up.
So Neil, like we Indians are very good at saving, right? So we save money, which we have to pay for good advisors or people who are advising us so on the boring lessons of personal finance. So how had been your experience? Say you started writing, say in the year 2016, and today we are in 2023. So people are getting more aware about it, or still they have a, I mean, conception in their mind that they are the best personal finance advisors for themselves until unless they lose big sum of money and find out that it is very much required in today's time.
Excellent question. So I see the problem slightly differently. Today we have only 1,300 SEBI registered investment advisors in India, that too on paper. In reality, there are probably 600, 700 practicing RIAs. So the vast majority of the market is served by distributors for mutual funds and agents for insurance, because insurance also has certain products which provide returns. Um, that is not the optimal solution in my view. The correct thing, I mean, the ideal thing that should exist is a vast body of RIAs who are providing advice and collecting fees, not charging commissions. Um, but the regulations are just so ludicrous that the entire growth of that profession is stunted, and it's probably going to go backwards over the next couple of years. Um, people, so people where so that's one set of people that people go to, the distributors or the insurance agents, and some of them do a good job. I'm not saying that you should only RIs do a good job. Clearly, there are lots of very high-minded distributors, high-minded even insurance agents. But the incentives are not ideal in my view. So that's one set of the market. The other set of the market, the young people, they go to influencers. They get onto YouTube and Instagram, and that's even more risky because an influencer does not owe you anything. An influencer is not contractually bound to you. So if he or she says something that uh, you end up losing money on, you have no recourse. And so here, I mean, that's the tragedy of the Indian market, that people know they need help, they need advice, and that's why they're going to influencers. That's why they're going to bank RMs. But that's not where they should ideally be going. They should be going to SEBI RIs, and that's just not happening.
Right, Neil. And Aditya, like I must congratulate you and team Complete Circle. You guys have been doing great work. So, like our attendees would be curious to know, like which sectors you guys are optimistic about with a view of say 3 to 5 years going from here.
Thank you, Prince. See, to be honest, I'm just going to repeat the sectors that our CIO had recently, spoken about at his CNBC interview. So we are bullish on banking, we are bullish on pharma, even on manufacturing, right? See, I would not really like to digress on the topic here, but if anyone is interested, I'll just drop in a link to that CNBC interview.
Right, right,
In fact,
surely.
we should provide the link to our book as well.
Yeah, exactly.
Right, right. I'll share it. So, guys, like, I mean, I have covered the questions which I had in mind. So, for our attendees, like, if you have any questions, so we can take your questions for last 5-10 minutes. So, Neil, Aditya, and Aprajita, like, any nuance of the book which I missed asking you, and you have in your mind, and you want to tell our attendees.
So I think broadly, I'll just sum up Rakesh's journey, that he began as a trader. He made some initial big bets on things like the Madhu Danwate budget. He was initially bullish on the Harshad Mehta boom, then he turned bearish. Then for a huge stretch in the late 90s, he sat out the TMT boom. Um, then something clicked in his mind in the early 2000s, and he turned extremely bullish on the Indian market. That's when he bought his big wealth creators, Titan, Lupin, Crisil, or at least big chunks in them. So with Titan, he seems to have bought a stake surprisingly earlier than that, um, and held on. He let those winners ride, um, and the losing bets that he made along the way, like DHFL, like A to Z, like Mandhara, they never managed to make a big dent because he did not double and triple down on them. He took those losses, but he let his winners run. And that in a nutshell is his journey. It is the figures are still mind-boggling. Like, I still can't wrap my head around how somebody can build a 35,000 crore fortune and start with virtually nothing. But he did, and it's a inspiration to us all.
Right, right, Neil. So guys, like I have shared a tweet in which the link to the book is given, and surely I would ask you guys to have a look at the book, and surely that would be a great value addition, learning from his journey and the hard work put in by three of our panelists today. And like Aditya, it will be released in Marathi soon, right?
Yeah, I mean, the book is getting translated into Marathi and Gujarati. Yeah.
That's great, and that would be helpful for most of the people who are very not very comfortable with English. So thank
Absolutely.
you. So yeah, thank you so much, guys. Like it was great to have you today, and learning about the nuances of his life, and those are holistically covered in the book. And surely look forward to the great book being sent to me by you guys, and surely I will come up with my feedback, and as soon as I complete the book. And my best wishes, may it be a bestseller in our country, and also look forward to many more books, maybe covering the investing journey of other people, or maybe even you guys can also share your journeys. So my best wishes. Thank you so much. Any closing remarks, Aditya and Aprajita?
Let me quickly go first. So, Prince, thank you so much for hosting this session. It's a privilege to be here, and I hope that we've given a nice overview of what is a very, very compelling story.
Yeah, Prince, and I must say that it is the very first. What do I say? It's very first podcast or spaces that we are doing, a very first event that we are doing linked to the big book altogether. So thank you so much for organizing it, and that too way too soon. This has been really great experience speaking to you guys.
Yeah,
Thank you.
just I'll
Thank
just
you.
end it. Thank you so much, Prince, and thank you to all the listeners. Like just want to end by saying that Mr. Jhunjhunwala had nothing but like Neil said, that networks figure that he had, at the end. I mean, it's an inspiration to all. And when I had started investing, right, the first thing that a friend had told me was to read up on RJ. So he had such an aura that before you could touch a book on fundamental analysis, right, you had to read up on him. So that was his magic, that was his aura, and that was the kind of respect he had. So we have summed up his entire journey, his history, his winners, his losers, what you should learn from him, what you should not learn from him. And I mean, that's all. It's full of stories, anecdotes, fun facts, and I'm sure you all will like it. So yeah, thank you, and good night, everyone.
Thank you, Aditya. So Aditya, like we got Sajal Kapoor sir with us. So Sajal
Oh,
sir,
awesome.
any comments to make, or congratulate Aditya and team for the great book?
No, absolutely. I mean, writing a book. I mean, I can, I can only imagine, what it takes to write a book, guys. So, hearty congratulations, and I look forward to getting some glimpses of that. I may not be able to read the whole book this year because I've got so many pots boiling at this end. But I truly appreciate the journey that you guys must have been through, and it takes a lot of blood, sweat, tears, pretty much everything, to think through your thoughts and then put it on a piece of paper and then erase it all over again, to try the next version, right? So it's a very iterative and incremental, it's a slow moving cycle. Let's be honest about it. Writing a good book is not a joke, and I can only imagine how long you guys must have been working on this project. But great news is that it's finally seen the light at the end of the tunnel, and everyone, I'm sure, is so hungry and keen to get their hands onto this masterpiece. I mean, it's been it's journey of a legend. The only sad part of the story is that we lost Jhunjhunwala ji. I mean, pretty early. I mean, 60 is no age. I mean, I was in a meeting. I couldn't join the whole session, but I can see that it's been recorded. So I look forward to um, tuning in later and experiencing all that you guys very generously must have shared during the podcast spaces. It's a loss for all the retail investors, because as far as I am concerned, I have seen him joining earnings calls and literally grilling and bombarding the company, the management. I have not seen institutional analysts do that, and the reason is that they want to protect the relationship, and fair enough, because they need to do their jobs as well. So there is nothing wrong in that, but RJ was someone who was bold and courageous, and he was blunt. So yeah, I mean, we all, it's a big loss. I mean, you can't put such a loss into sort of, a few words or sentences. It's something way beyond that. So that's all I could say.
Right, agree.
Thank you so much, sir.
Thank you.
Very kind of you.
Sajjan sir, thank you so much. It means a lot coming from you.
No, my pleasure, my pleasure.
So Aditya and Neil, like we also got Kaushik with us. So Kaushik, any comments to make, or maybe any tough question for Aditya, Neil, and Aprajita?
Hey, hi all. Sorry, I was late to join the call. I have a question, like how this story actually started to write a book on legendary investor of India.
So I'll take that. So Kaushik is an old friend of mine. Um, we started, there are two reasons. The deeper reason is that, as I said, at the start of the session, Rakesh embodies the Indian dream and embodies the Indian investor's dream. And, he's an extreme example. Most of us are not going to reach anywhere close to 35,000 crores. But it's by following the extremes that perhaps you can learn some lessons in your own journey, and maybe do a little bit better than you would have otherwise. On a practical note, we started. I was writing a different book initially on personal finance, and uh, you know, when Rakesh unfortunately passed away, somebody pointed out that you should focus on Rakesh. I mean, and the tremendous journey he's had. So I switched midways, and I got together this fantastic team, and it's been a dream since then.
Got it. And Neil, another question, like what was the actual learning that you people, all three of you, even Aditya is a good friend, and I just wanted to understand what actually you people learned by writing this book. Or there's something that I have to concentrate while I'm reading the book, and I'll be the first buyer. Huh?
It's very kind of you, Kaushik. So as authors, let me speak about that first, and then perhaps as an investor. As authors, you have to be open to new information. As in, it's a journey. Like, it's not like you spend X amount of weeks collecting information and then you write. You write, and then suddenly you discover something new, and then you have to keep changing things. So you have to deal with a certain level of frustration, that you have to keep changing and updating things. So you kind of mature as a writer as you go through the process. Um, and working as a team, especially, I think we did a fantastic job, because often when people are in teams, they clash, they have disputes, etc. But somehow this time we did not, to my, even to my surprise. So that was a great learning. You should find, people who are writing should find people who they're very well aligned with. As an investor, I would say that, I mean, there are two things that people should not learn, which is leverage and the small cap concentration. But his incredible sunny optimism towards stocks and towards India was a big part of his success, and that's something that all of us can definitely imbibe.
Yeah, Aditya, how about you?
I mean, see, Kaushik, definitely. I mean, there were a lot of learnings for me because this style of writing was completely different for me because if I take 2019, 2020, I was into long format articles. Then I switched over to Twitter and LinkedIn, where I used to just write short form articles. And writing a book is a completely different experience. Neil and Prajita are journalists, and they write a lot, so they were quite well tuned to it, but not me. But thankfully, like Neil said, we had a fantastic team. Neil and Prajita had been helping out, had been hand holding me a lot. Whenever I wanted to write a chapter, I used to run it by them, and they were very kind enough to correct my mistakes or just guide me. How do I write those things, or how do I put it across, right? So it was a very beautiful journey. I mean, honestly, before writing a book and after writing a book, I think I'm even more confident that okay, I can do more things in life. Learning the journey of Rakesh Jhunjhunwala, during the course of our research. We have visited a lot of places. We have met people who were close to him. Of course, some of those stories could not make it to the book, but it was just very beautiful to see Mr. Jhunjhunwala not from the point of view of an investor, but just as a human being, right? So, he was a very jolly person. He was quite open to speaking with anyone. He was very kind to his waiters. He used to speak with them. He used to tip them generously, right? He liked his alone time. So it was a very beautiful journey in that sorts. When we learned more about him, not just as an investor, but just as a human being. So, and I mean, overall, it was a beautiful experience writing this book, working with Neil and Aprajita, and I hope we get support from all of you to make it a bestseller. Fingers crossed.
So
No, I
like,
just add. Sorry, Prince. Just wanted to add one quick thing.
please, please.
So we actually went to this bar that he used to frequent called Jeffrey's in Marine Drive, and it's a very fascinating place. It's stuck in time, as in you don't these days see many places like that. It's strangely formal, but it's almost, I think, exactly the way it was when he used to frequent it. So if you're ever around that part of Bombay, do go there once. It's a lot of fun.
So it's on Marine Drive, and I sincerely request everyone that you do a kind of a tour. You go to BST, you go to Joffrey's, talk to one of the waiters, sit at his favorite place, and just try to soak in the place. Yeah, it's a beautiful thing to do.
So a question come to my mind, Sajal sir and Aditya. I'll take the question to both of you. Like, lately, Sajal sir, we were discussing about the small cap space, right? So if the due diligence is right, so still playing concentrated and big on the small cap is risky, or how exactly it should be viewed, provided the research is fine.
See, no, and how can you say see, research itself is a moving target, right? The data is a moving target. Management, what if your research is fine and the management changes tomorrow? Will you revisit your research and the outcome may be different? So for example, if the outcome is adverse, so you started with concentrated, let's say you have got less than 10, so whatever is the definition of concentrated, let's say a random number, 10 is the number of stocks. You had high quality small caps, best possible valuations, everything, and you allocated 10% each. And the very next day, there is an event which was difficult to forecast, because future is unpredictable. You don't know what you don't know, and there was COVID was a black swan, but at a micro level, company specific level, anything can change. Anything could happen to the management, the CEO, or the management. They maybe transition or whatever, and your thesis will be turned upside down. What would you do in that case? And the stock is down on lower circuit for whatever reason. So mistakes happen, right? So especially in case of small cash, be very careful in allocation. If you are having a portfolio which is solely of small caps, have no less than 30. I repeat, no less than 30. If all your stocks are into small caps, you have got no anchor investments in larger caps, because see, the volatility is much lower in a large cap. A large cap business reporting a quarterly earnings misses the earnings by, let's say, 10%. The street would react, marginally. Whereas a small cap, you miss the earnings and it will be down 20% lower circuit, flat. And nobody cares, where this asset would be 2 years out. Nobody cares. On that day, think about the emotions that you would have to go through. Think about your family. Think about your personal time. Think about your happiness quotient, so on and so forth. So, no, I mean, that's my personal take. I could be wrong. I'm just saying what I do. I never concentrate in small caps. I will just hedge my bets across the board. I mean, there is one small cap that I was nibbling. I mean, not a lot. Position size was very small, and it has been volatile, and I accept that, because I just go through a basket of stocks, and there is no such thing as a high quality asset forever. Um, when we all started Piramal, just take that as an example because it's a hot topic these days. Everything was fine, but we slowly started discovering the issues, right? So thesis change. If see, whenever there is a quote, right? Facts change, you change your thesis. Simple. And facts could change tomorrow, anytime.
Right, sir. So, Aditya, how you view this?
I think what Sajal sir said is extremely right. I mean, see, you have to really look at the risk and return appetite that you have, right? I mean, of course, small caps and mid caps can give you a kind of say good opportunity to make it big, but at the same time, on the contrary, they will also make you lose big, right? So, depending on the kind of risk appetite that you have, you can take a look at small caps and mid caps, but you should also be prepared for the ride that it will give you. So personally, I had been invested in small caps and mid caps, but slowly I have been shifting my portfolio to large caps. And the kind of bets that I like to get into small cap and mid cap are deep value stocks. So during the COVID period, I got a lot of good value bets in that, and these were say cigar butt kind of companies. जहाँ पे a company worth 100 rupees was trading at 20-30 rupees, right? So I played those companies.
Right. So we got one last speaker, Venkat. Venkat, you can quickly unmute and ask your question to the panelists.
Let me quickly just add something to that, Prince. So, for small cap investing, we've today itself put out asset allocation quilt, which gives the returns of different asset classes in each FI. So, in FI 21 and 2, small caps were at the very top of that table, and in the FI just gone by, they are at the bottom. Gold is at the top. So assets rotate in and out of rankings, and if you only have concentration in one single asset, the ride is going to be very, very, very bumpy. So if you have time, just look at that chart, look at that quilt we put out. Satya's right here; she's compiled it for us, and it tells you the returns of different asset classes: large caps, mid, gold, small caps, in each financial year for the past 10 financial years. So, so yeah, just wanted to add that point.
So guys, everyone just wanted to say that Satya was the one who read the book in a record time, and she proofread for read it for us. So a big thanks to Satya as well. She was a big part in this success.
Right. So Rajesh, you can quickly unmute and ask your question.
So basically, my question is related to the small cap and the mid cap. Basically, I was into large cap since when I started my investing, like 10 years back or 12 years back. But I was not so active in investing since 2020 March. Then I started investing heavily. Like that time, I had some lump sum amount of money, and the first time when I started investing seriously, that was I think in March 2020. Then I made good amount of money, but that was not because of my capability. I think I'm very even now I'm very new to market, and I cannot analyze many technical charts or even fundamental analysis, cash flow analysis on many sectors. I'm very a beginner even now, but luckily whatever I have invested so far made a good return, and in the last 2.5 3 years, I have made around 120 or 130% returns, cumulative return, not yearly, but cumulative return since 2020. But these all return came from 2 or 3 stocks which multiplied at 10x or some are 12x. Still, I'm holding and I have hardly sold anything. So I think that might be the reason I have got that return. But I'm afraid that I cannot continue this level of. Definitely, I cannot continue this kind of returns in the future. So, and also the large cap which I have invested have given moderate returns. Most of the stocks have given 10% or 12%, 15% yearly. Even some are given only 12% return over the last 3 years. So I'm little confused now what I should do now. Should I switch to a mutual fund, or should I keep investing in the stock directly? Currently, my mutual fund investments are only 10 or 15% of my portfolio. Even investments are higher, returns are very lower compared to my direct stock investments. So I have made big money in the stock market investing directly, but that's not because of my technical capability or the analysis capability that you might have already, but by luck I have made some money, that I only could say. So what would you suggest? I think there will be a lot more people like me who have make good money investing on 26th of March. I think that's the day I have invested heavily into the market. That was the big fall happened, and most of the stocks were available at dirt cheap price, and some of the companies which I know, which I am working on, was available at 1/5 of the price on that day. That was the reason I thought it will be a good bet, and I'm nothing going to lose. Even it's come back to the normal price, I'm going to make 3x or 4x in a 10-year time frame. But I could make it 12x in 3 years. That was a leg. But in going forward, I'm 100% sure this 130% profit in 3 years is not sustainable, and I cannot make it. And maybe I will lose money if I continue this. That's my question. What
Yeah,
what
Rajesh,
is your
I would
your
like to take it
question.
up. Yeah. So, first of all, I would like to compliment you that you could understand that you have to invest in markets when those are going down. So, on 26 March 2020, if you invested, that is really great. At least you got one thing right, that when markets are down, then you have to get into it in droves. So, first, this point, and then mutual fund investment, as you said, is just 10-15% of your portfolio. Then I would say that you need to focus on first your financial goals. So when you are investing in any product, then you must know why you are investing. So you have to identify your goals, and when you have those goals in mind, then you would know that, yeah, this is the time horizon that I should look at. And that is how you should approach investments. You don't have to earn 15%, 16% CAGR on all sort of investments. So if you have a 2-year, 3-year goal in mind, that you have to focus on different asset class. If you have a longer term horizon, then you can very well start investing in index funds. Index funds are really best investment product for anyone, for any retail investor. And as you know that when markets are down, if on those days you will add money in your monthly SIPs will go on. But if you track markets and you know that markets have fallen by 1,000, 2,000 points in a day, or even 600, 700 points in a day, then that day you should log in and you should make those additional investment, additional purchase. And if you do it, then you would notice that your CAGR is much higher than what a Nifty 50 does. So it has happened in my case. I had started investing from 2015, and I made sure that I'm putting up additional money on different days when markets are down. And I did not realize, and one day I was simply checking, looking into some data, and I realized my mutual fund investment, my index funds returns are quite nice. It has given me high double digit CAGR, more than what Nifty did. So that is one advice that I'll give you. First, focus on your financial goals, and that is how you plan your investment. And secondly, start investing in index fund. And about small cap and mid cap, I should say that Motilal Oswal Nifty 150 mid cap index fund. It's really great. I have been investing in it, I think, since 2019, and it has given me great returns. So you don't have to get into stock fundamental analysis of all these smaller companies. Simply start investing in mid cap index fund. So this will work out for you.
Rajesh,
Thanks
just
for
let me add
for
one technical point to Apajita's argument. So I concur with her. The technical point is that dividends, when you directly hold stocks, your dividends are taxed at your slab rate today. If you hold the same stocks through a mutual fund, the dividends flow into the mutual fund. They add to the NAV of the mutual fund, but you don't pay any tax on them until you actually redeem the units. and then it goes into long-term capital gains. It does not get taxed at your slab rate. So there is an inherent tax advantage to investing in stocks through mutual funds. Like Prajita said, index funds are a great way because they are low cost. And the example that you gave, that you got 100+% return. So I don't know if you meant CAGR or if you meant absolute, but the index is up 114% over the past 3 years. So even if you just bought the index, you would have realized this kind of return. Of course, you did a fantastic thing by picking that low point in the pandemic when we were all afraid and not sure what the hell was happening in the world.
Right, Neil. And it reminds me of Sajal sir, which once we were discussing in a session, like there is no shame in index investing and mutual funds. Like any 2 cents on this, Sajal sir, from your end?
No, no, absolutely. See, in the index is a rigged index. So when I say rigged, what I mean is that good companies, they keep finding place in the index, and the bad apples, they they are booted out, and it's a continuous phenomena. It happens periodically. So let's assume that you have got a nifty 50 index made of 50 stocks. The worst performing um, bunch would be booted out, and the companies that were previously not in nifty 50 but they have performed well in recent times, they will be added to nifty 50. So the quality of stocks that you will find in nifty 50 is always sacrosanct. So you are getting the best of both worlds. The volatility is lower, your expenses are lower, and at any point in time, without you doing anything, and just sucking your thumb, you are getting the benefit of exposure via the best 50 mid cap, large cap, whatever that index is. So definitely make the most of that rigging that the system automatically is doing within that index. It's like think of it as a difference. So it's like buying on the way up. So any company that is doing well, the stock is doing well, they say, always average up, never average down, never, average down a falling stock. Index is always average up by default. Good companies are only coming into that, right? And bad companies are leaving. So it's a brilliant setup. Everyone should exploit it, because it kind of saves your time. Otherwise you'd be reading transcripts and annual reports, and not just the annual reports and transcripts of the company where you are invested in. You have to go through the entire universe. It's a time consuming, tedious effort. So if you are into direct investing, whether it's mid caps or small caps or even large caps for that matter, you have to put in a lot of effort, and index investing will save you from all that effort. So if you adjust your returns for the effort that you have put in, I think it's a multi-bagger return.
Right, sir. Okay.
Yeah, I mean, see, it's very subjective. And before I say anything, I say another word. I just want to say that, see, I'm a part of a PMS team, so whatever I say should not be construed as a recommendation. Please do your own due diligence while taking up any financial decision, or consult your own financial advisor. Okay, with that out of the way, see, I mean, it's a very subjective question. Like I said before, it depends from person to person. A person can have 100% small mid cap allocation. A person can have 100% active allocation. A person can have 100% passive allocation. Like Swajal sir said, the game of direct equity investing, or say a small cap mid cap investing, is very different. You have it is a business, right? And you have to actually allocate your time, your blood, your sweat, your tears to that business, right? So if you are doing direct equity, make sure that you are well aware of the kind of companies that you're investing in. You stay updated with all the information that the company puts out. Say the quarterly results, the con calls, the annual reports. Every quarter, just try to check if the direction of the company is right or wrong. Read the annual report, read between the lines. I mean, uh, again, it's a very philosophical answer, but you have to make sure that the company ticks off on all the checklist boxes. So Personally for me, I'm all into direct equity because I have the time. I'm full time into markets. I do equity research for a living. So, it has been very suitable for me. But, I see a lot of my friends who are not that much into direct equity. So they're into the mutual fund route. So they try to balance between active and passive. They would do, say, 70-80% active funds and 20% passive funds, because then, like Sajal sir said, you get the best of both worlds. Nifty would have better companies coming in. By the law of selection itself, good companies will get selected in the index, and you'll automatically own them. So that is kind of an autopilot mode where you just keep putting money. And like Rajesh was saying, right, he invested on the day when the market had hit the lower socket. So you can tactically tweak those passive strategies jahan pe whenever the market falls, you can put in more money, and that can actually enhance the returns that you get on an index fund. So that is my take. It's very subjective. Please do your own due diligence before you actually take up a decision. And yeah, I mean, that's about it.
Yeah, Aditya, and like I see Jitendra in the listeners. So the other day he was discussing about I mean, basically the quality of content at the YouTube channel CFA Institute is above every. I mean, you can say the market is summarized in those videos, and it is actually a crime that those kind of rich videos get so less views in comparison to the videos in which tips and the people go after seeking tips in telegram channels and all. So that is the
See,
reason, like,
Prince,
very few people make money in the market.
the thing is, Prince, see, we live in the age of convenience, right? You want food, you'll go to Zomato. You want groceries, you'll go to Zepto. You want money making tips, will come to Twitter, Instagram, Facebook, YouTube, whatever it is, right? Nobody wants to actually go through 30, 60-minute videos which will actually tell you how to fish, right? People want the fish. People want to get rich overnight, right? It's the age of convenience, as simple as that. And that's the reason why, really good videos, even I feel very sad when ppafs videos which actually summarize the complete sector, complex sectors such as insurance, technology, AI, ML, they have beautifully summed it up in 60-90 minutes. But look at the views on that, and look at the views on a YouTube video titled best 5 multi-baggers under 50 rupees. You will come to understand what the problem is.
Exactly. But Aditya, that doesn't stop us and good people from sharing quality content. And obviously, if we can make it reach to one person one day, even then we are helping the society big time.
Yeah, absolutely. See, boom and busts will keep happening. We are here for the long term. Consistency is underrated, as simple as that. People try to run after hyper growth and stuff like that, but consistency is something that everyone should run after, right? Just look at Warren Buffett. It's not as if he's making 50% CAGR, right? But he has made that CAGR for 40, 50, 60 years, 70 years, right? 80 years. And that is why, people worship him, as simple as that. So he's the best example of consistency, not hyper growth.
All right. Sajal sir, you were saying something?
No. I lost my train of thoughts. Maybe I had something on my mind, and I unmuted. But yeah, no, nothing to add. But yeah, I completely agree with Aditya there. Sensible investing, common sense investing is hard in the sense that you need to keep fine tuning your process, but it's also something that you enjoy. I mean, it depends on person to person, your cash flow, your goals, what kind of person you are, what suits you, what doesn't suit you. I mean, there is there are very great technical chart readers, and it suits their profile, and they keep a very strict stop loss. They know how to play with the setup, and they do brilliantly. And these are the guys who would never post these screenshots on Twitter or other social media. They just follow the process and quietly continue to fine tune. And there are so many. I mean, there are a very good technical chart analyst in my own network, and often I seek their second opinion once I'm convinced with my fundamental analysis, and everything, before I take any sort of decision. I do consult them, because it it pays to have a second opinion, especially from a different perspective. So the technical lens is very different compared to the fundamental lens, and it makes every sense to take that view into consideration and then um, decide accordingly. uh, I mean, sometimes it changes my decision, sometimes it doesn't, but that's a separate thing. But respect what you know, and try and stay inside your circle of competence. So technical analysis, if you are good in technical analysis, and if you are staying inside your technical analysis boundaries, the process that you understand and follow, that's also staying inside your circle of competence. And that's that that's a common sense basically. And I agree that, this is someone said, I think Aditya or someone, that it's an era of everything in a jiffy. So you want fast food, you want everything quick. um, to make decent gains, to make large gains, um, buy in panic, buy in mayhem, and buy good quality small caps in mayhem, but then have the courage and the conviction to hold on, because market will give you so many opportunities to um, exit midway. And I've committed those serious mistakes early on. And that's the reason I say, if you ask me what is my biggest lesson, in my journey, the biggest lesson is, don't sell because this stock has doubled. Don't sell just because this stock has tripled. There has to be other reasons you have to exit. I mean, the thesis has changed, or you missed something initially. You realize that you made the mistake in your screening criteria wasn't perfect. Yes, sell on those. If you need cash, then you have to sell. And if the other instances, if there is another opportunity which wasn't there previously and it's much cheaper, then it makes sense to switch from an expensive looking asset to a much cheaper one, as long as you have done your due diligence, etc., etc. um that's all I could say. Thank you.
Right. So Neil, you have something to say? I mean, you done saying that?
No, nothing to add really. I think there was one question in the comments about what about holding small cap stocks for 10 or 20 years? And in the long run, yes, they do make a lot of wealth, but it's just that the ride is very, very bumpy, as our asset allocation quilt shows. So you can find that on my timeline. Um, Prince, I think we should probably call it a night.
Right,
It's
right. So
9:40.
before we close, a big shout out for you guys, for the incredible work you did, and surely look forward to the great book, and my best wishes once again. And surely I would
Thank you
request,
so much.
like, everyone should have a should access the book of the legendary big bull, late Rakesh Jhunjhunwala ji, and I hope we get uh, the right inspiration from him. Okay, Satya has sent a request. So Neil, before we close, okay, she got dropped. Yeah, yeah, Satya.
Satya, are you there?
Hi. Can you hear me?
Yes, Satya, loud and
Yeah,
clear.
Yes.
hi. Thanks. No, I don't have any questions. Thank you so much for joining me as a speaker here. I just want to congratulate all three of you, Neil, Aditya, and Aprajita, for coming out with such a fantastic book. I just also want to mention that I read the book and I really thoroughly enjoyed reading it. And it's really, I mean, it's a repository of so much information about Mr. Rakesh Jhunjhunwala. We all looked up to him, but this book gives a deep dive into how he started, his learnings, his mistakes. So it was fantastic. So one thing that I really enjoyed and surprising is how he started his journey as a technical analyst to get the capital to be here.
Hello. Is there some audio issue? Can everyone hear
No,
Satya?
He's
yeah,
quite
we
clear.
can
I
hear.
can
Yeah,
very well
we
hear
can,
her.
we can.
Aditya, can
Satya,
you hear
go ahead,
Satya?
please.
Yeah, I can. Yeah.
Yeah, Neil, everybody can hear. So, yeah,
No, thank you so much,
Satya,
Satya.
continue, please. Satya, please
yeah.
continue.
So I was just saying how Rakesh Jhunjhunwala has actually started, being a technical analyst and then moved to the being a fundamental, analyst. And the one thing that I really liked is that he maintained two different strategies. In the trading strategy, for the trading, he followed this momentum strategy but for the fundamentals, he followed this value strategy. I mean, both are two different extreme strategies, but I think the book also talks about how he maintained two different strategies in a very nice way and never combined both is something that I really enjoyed reading. It's not just that, also his of course we're all humans. I think the book also highlights his mistakes in his investing journey, about investing in DHFL and A to Z maintenance, right? And Mandana, another company. So I really enjoyed reading both mistakes as well as how he grew. So I recommend everybody to buy this book and give it a shot. It was fantastic. And Neil, Aditya, Aprajita, once again, hearty congratulations. I'm really happy for you guys. This is huge.
Thank you so much, Satya.
Thank you,
Thank
Satya.
you so
Thank
much.
you so much.
Thank you, Satya. And like those who are already aware of Aditya, Neil, and Aparajita, they know that the quality of content which they share, and that is a cumulative effort of all three, and great learnings from Rakesh. So with this, I take your leave, guys. Thank you so much. And the session is recorded. There were so many parallel spaces today. So surely those who missed out on it can surely listen to the recording, which I'll be sharing shortly and tagging you guys. So thank you once again for coming and sharing your great insights. And investing is one thing we can talk at length always. So thank you again, guys, and thank you Satya for your part as well. And best wishes again.
Thank you, Prince. Thank you, everyone, for
Thank you, Prince.
joining.
Thanks, Prince.